Hello everybody, Jackson here from the Wolf Squad. Today we'll be talking about how to tell if a dividend is safe. We'll be talking about three different aspects of a dividend stock. First off, looking at the dividend yield, which is sometimes the most telling, right? Because if you see a dividend stock paying 8% compared to another stock paying 2%, you're going to be a lot more skeptical about that stock paying 8% rather than the 2%, right? Because the 8% yield carries some more risk, although a heavier reward, and the 2% carries less risk and a less reward. So it's up to you as an investor to find what stock is the better bang for your buck, right? You don't want to buy in a dying business paying 8% yield. Even though it does pay that 8% yield, the stock may fall 20, 30% that year, and you're negative, right? You're negative 20% at least. But a stock paying a 2% yield could actually rise 10, 20% a year, and you're making a lot more than that 8% yield, even if it's not on cash flow through capital appreciation, right? So there is no minimum or maximum yield to aim for. It is all based on preference and actual market conditions, right? Consider this: if a $50 stock is paying, 5% yield, and then the stock gets cut in half, right? It has a series of bad quarters, and at the end of the year, it's now trading at $25, but the business is still pretty stable, right? Maybe the bad quarters are overblown. It wasn't actually that bad. And now the stock's paying a 10% yield. You look at this and you're like, okay, 10% is highly questionable. Should I even buy into this stock? Well, that's up to you, right? Because sometimes a stock trading with a 10% yield could bounce back, and that yield will turn into 5%, but your yield on cost still stays at 10%, making you money throughout the year. So it is up to you, but generally the 1 to 4% range is safe. The 5 to 7% range is slightly questionable, right? Just be aware. And 8 to 10 is very questionable. Anything above 10, try to avoid, right? But it's all based on underlying business, and of course your preferred preferences of risk and your tolerance. Now, the dividend yield of different companies varies on what stage of a company they're at, right? Apple, Microsoft, they're still, 40 years into business. Johnson & Johnson and Waste Management, on the other hand, they're a lot longer than that, and they're not tech companies either. These are tech companies growing at 20% a year. In the last 5 years, I've at least tripled. While Johnson & Johnson and Waste Management, on the other hand, is kind of a slower grower, but still growing at a good rate, and they're all worth your money, right? It's just based on what you think. But that's just a dividend yield. That's how it ranges, right? If Microsoft grows 30% a year, you're going to watch your dividend yield fall compared to Waste Management growing 8% a year when their dividend's still growing, at 8% a year. That dividend yield is going to stay the same. Now, another way to tell if a dividend is safe is the payout ratio. Now, this dives deeper into the business rather than just looking on how much they pay, looking at how much they pay through their actual income. So the payout ratio is the percentage of income given to shareholders through dividends, right? A payout ratio under 75% is usually safe, but it's, again, based on preference. And if you want more or less risk, right, simply raise or lower your minimum payout ratio. So exceptions are real estate investment trusts, because they do have to pay 90% of their income in dividends. So this does exclude them, but the payout ratio is calculated doing the dividends per share yearly over the earnings per share, right? So anything above 100%, that means that the company is paying more in dividends than they're actually earning in income. Avoid, obviously, right? Unless it's a real estate investment trust. That's a different topic. But you can see Apple has a 15% payout ratio, Microsoft at the 25%, and then Johnson & Johnson Waste Management with a higher payout ratio with 43 and 46. It means that 43% of Johnson & Johnson's income is given out as dividends. The rest is reinvested, right? Same with Waste Management with 46, same with Microsoft 25, and Apple with the 15. But the lower payout ratio generally means that the company could grow more, right? Because they're reinvesting back into the company. So you got to ask yourself, do you want a grower or a payer based on preference? Lastly is the dividend growth, right? The growth of the dividend over the last 5 years. That's a good time range to look at. Look for continuous dividend growth of at least or around 5% a year, right? You don't want 1 to 2% a year. You want to at least try and beat inflation. The higher the growth, the better, but also the company that pays on time in the same growing amount every year is the most preferred. You know, if they're paying every quarter and they're growing each year by 8%, that's a lot better than the company sporadically growing 20% a year and then 5 years down the road, another 10%, you know. Just look for the consistent payer. Aim for companies that are reliable and still grow their dividend every year without actually hurting the business, right? Because some companies pay us such a high dividend that it hurts the underlying business. You want to avoid that. Here we have the 5-year dividend growth for these stocks. Apple at 9.3, Microsoft at 9.2. And then you'll see Johnson & Johnson and Waste Management at a lower rate just because their company is, slowing down in terms of growth. Johnson & Johnson with a 6% and Waste Management with a 7.1. But also consider that these aren't tech stocks. You know, they're consumer cyclical like Waste Management. They're picking up trash and healthcare, right? They're selling Band-Aids and vaccines. So just understand the differences between these companies. And of course, tech stocks are going to grow their dividend more, but just remember their dividend yield is under 1%, where Johnson & Johnson's at 2 point something and Waste Management's at 1.5. So just look at these different factors when looking at a dividend stock. You know, see for yourself if you think that the risk is there and how much risk you're willing to accept. But besides that, that's the end of the video. Thank you for watching, and until next time.